Welcome to Wise Beyond Bitcoin, your home for the crypto neo news, education, and opportunities, and the macro updates. My name is Ryan.
My name is Lucas, and we've got a little bit of a macro update to follow up, something we've been talking about for quite some time. We've been following the decline of the crypto blockchain market since the beginning, I guess, when the Fed started announcing its tapering and the rate hikes that were going to take place last year. And we'll continue to give you the updated, the latest and greatest. Now, this is more along the lines of the fight against inflation and what is that going to mean for future Fed policy? And is inflation the only battle for the Fed and for the market? So without further ado, Ryan, what did you find, brother? Let's get into it.
Yeah, well, this morning we got the numbers, the inflation numbers out of the BLS for July, and we see that the consumer price index has risen for that month by 8.5%, which is less than the previous month, which was over 9%. And we're seeing some signs of inflation abating, potentially has peaked. It's a mixed, there's other elements to look at. Labor markets are still very, still shows very strength. There's a lot of hiring, and there's, wages are going up. So there's still a lot of strength in the labor market. So that's suggesting that inflation is not, defeated by any stretch. And we're still looking at elevated inflation. Core inflation, core CPI is still at around 5.9%, which is roughly holding what it was last month. But that's still really high. I mean, 5.9%, that's excluding food and energy, but that's still elevated from, the traditional 2-3% that, that we're kind of used to and what we're targeting. But it's nonetheless, great. We have to be, take whatever good news we can get. The markets are loving it, right? Stock markets are up, crypto markets are doing great. And it is good to see that these numbers are starting to come down a little bit.
Now, it shows in this article, according to AAA, the national average price for regular unleaded gasoline is now $4, down from $4.68. And as you mentioned, the core CPI, which excludes food and energy, stayed about the same, 5.9%. So what we're really finding here is that the major inflationary pressure that was caused by the surge in energy prices, now that's been quelled, now that they've brought down gas prices and energy prices, that's really what's been leading the deflation, so to speak, or bringing those inflation numbers down. When we take a look at everything, it's mainly due to the change in prices of energy consumption.
That's right. And here we have the actual data from the BLS. We'll link all this below. You can see exactly what's going on with the different sectors of the economy. Food is up 1% total. Food away from home is a little more than food at home. You've got energy, which you just mentioned, that's where the big declines in prices you're seeing. That's really what's driving the headline number down.
And those tend to be very easily malleable, when it comes to state intervention and taxes and other things. So it doesn't really tell the whole picture of, what people are feeling when it comes to inflation, when they go to the grocery store, when they go to other places, in life. So it's good news that the inflation numbers are down, but that's why we break down, this index and really peel behind what does that mean? Because the inflation numbers being down, what does this mean for the health of the economy and the actions that the Fed is going to take in the future?
Well, it's taken alone, taken in isolation, not looking at labor markets, not looking at anything else, just looking at the inflation numbers. It definitely reduces the risk of, say, like a 1% rate hike next month, right? That was kind of on the table somewhat last month when we were talking about looking at the inflation data. They had numbers were even worse than the month before in June, and everybody was panicking. And so there was talk of a 1% rate hike in the next meeting. It didn't happen. And then, now we got the data about the labor market's doing so well. All these jobs were being created that we didn't expect. So I would think that there's still some chance of, of a greater than normal rate hike. But now you get this inflation data saying that we might have peaked. Energy is coming down. that potentially the worst of is behind us. And if that's the case, then it takes the pressure off the Fed a little bit, and maybe we can consider a 0.5% rate hike, or because they're looking towards trying to pivot as well. They don't want to do it too early, but they don't want to wait too long either and overcorrect. So it's taken in isolation. It definitely reduces the risk of a higher than expected rate hike.
Mhm. So good news on the inflation front. The markets have responded accordingly. However, one of the themes that we've been covering for a long time when it comes to, handling, the Fed managing expectations and how often good news can be bad news and bad news can be good news. There is another side to the story of actions that the Fed is taking and is going to take, which I feel good news on the inflation front. Like we talked about in the past, good news in labor markets could lead to higher rate hikes. We could also see that good news in inflation could lead to the Fed feeling more liberal and taking other necessary drastic actions that could affect the liquidity and the overall growth of the economy.
What we're talking about is, what is the Fed doing with its balance sheet? And we have entered in a period called QT, quantitative tightening. It's the very opposite of quantitative easing, or QE, which we lived through for almost a decade. So what is quantitative tightening? Well, this is when the Fed sells or shrinks its balance sheet. It's either selling assets that it's purchased previously, or it's letting those assets roll off the books as they mature, and as the holder of that debt is then paid because they waited, the bond has been paid, then they can just let that, instead of reinvesting those payments and then getting another position in a similar sized position, they just let that go, and that's what rolling off the balance sheet means. And so we've already had this has been going on since June, that they've been letting the balance sheet shrink by 30 billion in treasuries and 17 billion in mortgage-backed securities, and that's going to escalate and double starting next month. It's going to be 60 billion in treasuries and 35 billion in mortgage-backed securities, and the goal is to shrink the balance sheet by roughly $2.5 trillion. And this is coming on the heels of increasing the balance sheet by 4.5 trillion. So we're not completely unwinding QE, but we are talking about unwinding it by about half. And this is estimated to go on for over 2 years. Now, this is where it gets interesting. Go ahead.
Yeah. So we'll definitely go into detail and follow up, because this is a whole nother dynamic and aspect to the economy. But like you said, it doesn't happen in a vacuum and ceteris paribus. While the inflation numbers are great, and while the Fed may be reacting to lower rate hikes on that side, there are other things that can be done that are equivalent to rate hikes when it comes to affecting the growth of the economy outside of the traditional rate hike. So good news as far as the inflation numbers, or at least the reported adjusted inflation numbers slowing down, and those actions being taken. That being said, be aware that this isn't that we like to give the macro outlook, the long-term perspective. That's what we share.
Right.
And like this information, this is not financial advice, marital advice, commercial advice. It's just educational, entertainment information. We're sharing our research and passion for economics and blockchain technology, and how these markets interact. And there are some exciting interactions with this new technology and the traditional markets, especially in the last year. We can see more of these interactions taking place. This is a big deal because we talk about the correlation of blockchain and crypto. It's just like the energy sector or technology sector. And if we're seeing a major reduction in the balance sheet of the Fed, if we're seeing a major pullback in the economy at large, it will affect blockchain and crypto. So we say, take a breath. The technologies that are worth anything in this field will be around for a long time. So do your research, and it's a great time. You're still very early. Many of these applications and blockchain projects are just now developing and collaborating with other large corporate commercial institutions that have been around for a long time. We're really seeing the blend, and we're seeing people start to look at how they can regulate and oversee the growth of this new market from the traditional sector. And it's exciting. Sometimes not the best policies maybe being pushed forward, but that's why we're here and others are here, so that we can learn, educate, and help each other make the best of this new technology, because there's a lot of opportunity and potential for the world at large, and for you possibly, if you're watching this and your family. We can look at ways that those who are part of new technologies and helping things early, these innovations, can often benefit from that adoption. What's it called? The Metcalf, or no, what's the adoption? The network effects. There we go.
Oh, yes.
So join our network if you like this kind of stuff, and we'll continue to share you. We got playlists, talk about how to get involved. We have DeFi, we have tutorials with Web 3.0 wallets, how to stake, NFTs, privacy and blockchain, interoperability, a lot of hot topics that we will continue to cover. And we will continue to provide other educational, tutorial, tutoring resources for those who are interested in learning more. You know what to do. Until the next time, have a beautiful day. Namaste, y'all.
Thank you.